So if you can talk about that, how to utilize those to reduce your tax liability.
Absolutely. So again, you definitely have to make sure that you know, are you the real estate professional? Are you the active or are you the passive? Okay, because this will impact the different levels differently. But let's stick with our real estate professional from this end. Cost segregation, cost seg plus a real estate professional plus somebody else who's making a ton of money. This combination is the perfect, it is the golden child of the entire tax code. Okay. So let's say you've got one spouse making $300,000 a year on a W-2 and the other spouse as the real estate professional. Cost segregation allows any piece of real estate to be broken down into its components. So if we were to look around the room, so I'll pick on your room, right? We've got a plant and a table and artwork, but there's also a wall, there's wiring, there's lights overhead, there's a desk, there's probably flooring, carpet. I'm pretty sure you're not sitting on hard concrete, right? There's something in the room. When
Right.
you look at a building from cost segregation purposes, you are pulling apart all of the components of the building to speed up the depreciation.
This is a Real Estate Vibe Show, and I'm your host, Vinki Loomba. As a real estate investor and a fund manager, I'm always excited to explore the world of real estate opportunities with you and for you. And today I have a very special guest, and her name is Shauna, the tax goddess. Welcome, Shauna, to the Real Estate Vibe Show.
Oh, thanks so much for having me. I'm excited to be here.
Likewise. So, a little bit about Shauna. Shauna is a CPA and founder of Tax Goddess Business Services, leading a top ranked fully digital firm that has saved clients over 1 billion in taxes, specializing in custom tax strategies for business owners and investors. She has organized among the top 1% of tax strategists in US and has been featured on platforms like Forbes, CNN Money, and Entrepreneur. We all know top tax saving strategies is crucial topic for everyone, right? And especially at this time, I think this is the most relevant topic. Taxes can significantly impact our bottom line. And understanding how to maximize deductions and take tax advantages um, are the best opportunities out there to save on taxes. That boosts our profitability. And with the right strategies and the right approach, real estate investors, including me, we can legally reduce our tax burdens, reinvest savings into our portfolios, and grow our wealth much faster. So, staying informed on tax strategies is key to long term success in the ever evolving real estate market or otherwise. So, today we are diving into everyone's favorite topic, top tax saving strategies for real estate investors. I'm pretty sure you're all gonna love it. So the first question I'm gonna start with, Shauna, is why are tax saving strategies so crucial for real estate investors? And how can it directly impact the profitability for anybody and everybody?
Absolutely. Well, so one of the cool parts about real estate, of course, we've got the three different levels, right? Real estate professional, active real estate, passive real estate. Now, if you're a real estate professional and you've been in it for a length of time, your tax rate is probably already zero, right? You're probably already utilizing cost segregation and paying your kids and hopefully even writing off your dog as security, all the good stuff. So you're already using kind of these low hanging fruit. But for many people that are in the active status or in the passive status, they don't get the same cool benefits that a real estate professional status does. So we're always looking for building other tax strategies to try to get us to the lowest tax rate possible. Considering for most people, taxes are the most expensive thing that they pay, right? Depending on where you live, California taxes can go as high as 63%, which for a lot of people is unreasonable. It's a little much. And one of the things that I love about being a tax goddess, a tax strategist specifically, is our average tax rate for our clients is 6.92%. Now, for those of you that are already your real estate professionals and you're already at zero, let's get you to some credit carry forwards. Let's get you to some NOL losses that we can carry forward to offset into the future against property sales so you don't have the 1031 or some other big rollovers. Let's get your 401ks rolled into Roth, right? We have lots of options if we can get you some nice, big, fat, healthy, negative tax returns, NOLs, and keep you at that 0%. So
That's awesome. I love it how you said the low-hanging fruit. A lot of people know about that and utilize it, but I don't think still it's being utilized 100%. So let's talk about that. Let's start from there, the low-hanging fruit. So how it could be strategized for most of the people, and let's start with the passive investors because they already have ordinary income, which is kind of quite a bit. And then just it's not easy to write off in taxes 100% because they are not the real estate professionals, number one. Number two is just like capital gain is different than the ordinary income. So if you can talk about that.
100%. So we really have three different kind of case examples, right? So if we're sticking with our passive, so let's say we've got somebody 500,000 married couple on a W-2. Okay, they own 2 or 3 rental properties, but completely passive, or they've invested in a syndication, completely passive, right? They are not actively managing, they're not calling the plumber, passive, right? They're not doing anything.
Mhm.
As you go through that scale between passive to full real estate professional, typically what you look at is how are you investing your cash? Okay. So with somebody who's passive, yes, they could buy another rental property, but if it's passive, it doesn't really help them for their taxes. So
Mhm.
when we're talking about passive, buying real estate, you're more looking at long-term growth, empire building, wealth, this kind of thing. But for tax strategy purposes, you may need to look to invest elsewhere. So you may be looking at oil and gas or solar or tribal credits. You may be looking at SOPs. My brain always goes to strategic opportunities, but SOP partnerships. So there's a million different types of things you can get into, but real estate itself is probably not going to help you if you are passive. Okay. Real estate professional, of course, go with real estate, stick with real estate. That's what you know, that's where you're getting the benefits. So when we look at how much cash we have to invest, somebody who's a real estate professional may invest $100,000 as their down payment on that property. Somebody who's on the passive end may invest $100,000 into oil and gas to get the same or better benefits than the real estate professionals. So when we look at which strategy is the right strategy for each user, for each taxpayer, it not only depends on where are you on that scale between passive, active, and real estate professional, but also what do you want, right?
Exactly.
We've seen cases where a passive person already has a portfolio of 20 properties. They don't
Mhm.
necessarily want more properties. They want to diversify a little bit. So we're going to get into Belize tree farming. Okay, there's a million and one different kinds of investments when you're coming at it from the passive angle.
Yeah, that's a really good angle. I like that. Diversification is very, very important, and diversification gives you room to grow as well as save on taxes. And these are the strategies that we're talking today is all about the wealth generation strategies, beside the tax savings too, because you're growing as well as you're saving. So a lot of time I get this question, that do you have a good CPA, or I'm working with my current accountant and I don't think I'm getting enough benefits on my tax savings,
Yeah.
or is it being done correctly? So what could be the answer to that? How can average person look up and make sure that they're getting the 100% benefit, whatever they're entitled to?
Yeah. So I think the way to do this, let me come at it from a different perspective. There
Mhm.
are different types of financial professionals in the world. Okay.
Mhm.
So you have your bookkeeper who handles your day to day, right? They're paying the bills, they're making sure that the plumber gets his invoice paid so he comes back the next time when you need him, right? You got your day to day bookkeeper. They're probably doing your QuickBooks, right? Maybe you've got a property management company who's handling your day to day financials. Okay. Your second level is your CPA. Now, your CPA's job, and this is where a lot of people just don't know any better, your CPA's job is not to bring you tax strategy. That is not their job. That is not what they're hired to do. When you hire a CPA, the CPA's job is to take your information, gut it on the tax return, file it properly, check all the right boxes, right? File it properly so you don't get an audit. And I think so many people are confused about, well, my CPA is also my strategist. No, they're not. If you look at the numbers, okay, so according to Google, there are 660,000 CPAs in the entire United States. You probably have one of those, right, as your CPA. Now, even within the CPAs don't all prepare taxes, right? You have CPAs that are CFOs, you have CPAs that are auditors, you have CPAs that do bookkeeping, right? I mean, you have CPAs that are financial advisors, right? All sorts of different things. When you start to specialize in taxation, so generally you have CPA first, then you have masters in tax, and for any of you that can see all these qualifications behind my name, right, you start to specialize. So masters in tax, there's only 60,000 with masters in tax in the entire US. So it's 10% of all CPAs specialize in tax. From there, you go to certified tax coach, which there's only 607. Then you go to certified tax professional, and then you go to certified tax strategist. There's only 15, 1, 5. So when you're looking for tax strategy, really, if you don't have the CTC, certified tax coach and higher, you are not working with a tax strategist, right? You're working with a CPA who maybe knows some of those low-hanging fruit, right? Let's pay the kids and write off the dog and buy that new G-Wagon, right? The big thing this year is the G-Wagon. Everybody wants the G-Wagon, okay? So when you're really looking for who belongs on that financial team, it's your bookkeeper. That might be you. It's your CPA who's filing the actual tax return, and it's the strategist on top of your real estate broker and your estate and trust attorney and your corporate attorney and all the other people that need to be a part of your overall team to really get the best benefit to minimize your tax to the bare legal minimum that you're required to pay. So.
Great. I love that explanation. I think that makes you truly the tax goddess, which is awesome.
Well, they rank us, right? And I know I'm in the top 3. They refuse to tell us who's number 1, but I've spoken to the other 2. So I think I know, maybe. I don't know. Anyway.
Tell me about a little bit about this. How did you get started with this tax goddess form?
Oh, that's so sweet of you to ask. So yeah, long story short, I promise it's not ego. It was by complete accident. So I was at a networking event. So Tax Goddess, my firm, is 20 years old. We just turned 20 in this past August. And thank you. And so this was when I was year 3, year 4. It was way early in the business. And I was at a networking event, okay, and I'm a little bit of a chatterbox. Nobody ever believes I'm a CPA because they're like, you have too much personality to be a CPA. So, I get it. So I'm a little chatterbox, and I'm talking away to the person sitting next to me at this networking event, and I get tapped on the shoulder and a microphone shoved in my face, and I stand up, give your 30-second commercial, and so I stood up and I went, hi, I'm Shauna the Tax Goddess. And every head in the room spun. And a very good friend of mine, way in the back, he was a marketing guru, and he said, everywhere, everything has to say Tax Goddess. And so we changed the firm name and my name. People don't even call me by my last name anymore. It's way too long and German and too many letters. So everybody always calls me Shauna the Tax Goddess. So it kind of stuck, and it kind of goes along with the personality and the red hair, I think. So all the good bits.
Nice, good. So tell us a little bit about your background too. Where are you from? You mentioned a little bit German background, a little bit there. So
100%.
this was your dream to form this firm someday called Tax Goddess. How did that go on?
No, I'll be honest. Well, so let's back up. So yeah, little bit of background. So I'm actually originally Canadian. My family is in construction. So came down from Canada to, I now live in Paradise Valley, Arizona, followed the snowbirds, right? And very long story short, I started off in astrophysics. Okay, I wanted to work for Jet Propulsion Labs. I've got a numbers mind, right? It just kind of sits well in my brain from that standpoint. And I came home from college. I think it was the end of my first year of college, and I was all happy. Astronomy, physics, I was in my dream world. Life was great. came home and was sitting across the breakfast table from my mom. Now, my mom is German, stoic, very straight laced. Okay. And she's opening the mail, sitting across the table. And she kind of, opens this piece of mail and puts it down on the table and pushes back from the table. And when you have a stoic German mother, you look up, like you react to that. Like what's going
Right.
on? Or what's happening? Oh, I got a notice from the IRS and they want more money. And, this is why I have a CPA and a tax attorney and they still can't figure out how to reduce my tax bill. Okay, well, when your mama is upset, you get upset, right? Like it's just how it is. And so when I went back to college, I said, okay, great, I'm going to stay on the astrophysics here, but like I'm going to start taking some classes. Let's take accounting, finance, tax, like anything I could get my hands on because I'm smart. Now, this is where the ego does come in, right? I'm 19 thinking I'm going to do better than the tax CPAs, right? Well, very long story short, and actually, if you want to hear the story, the full story, you can find it in our most recent book, which just came out last year in July, The 6% Life.
Wow.
Talks through the story, but yeah, very long story short, my mom is now enjoying the 6% life. Our average tax rate for our clients is 6.92%. So she is enjoying the 6% life. And I did do better than her tax attorney and her CPA at the time. So it only took a few years, but there you go. So yeah, I guess 25 years later, I'm ex KPMG, worked for the really, really, really big companies. And I've always just had this drive and passion for the entrepreneur. So help my mama and help everybody else. And the only people that don't like me are the IRS. So all the good bits.
That's awesome. And how did that book come about?
Yeah. Well, so long story short, what I love about that particular book, okay, so this is the second book. What I love about that particular book, it goes over, we talked earlier about the low hanging fruit, okay?
Right.
You asked how do people understand whether their CPA is really giving them strategy? Buy a copy of the book. It's on Amazon. Okay, we actually beat out, side note, you'd appreciate this. We beat out Think and Grow Rich for 3 weeks in a row on the Amazon bestseller list. So for finance, which super
Congratulations.
cool. Thank you.
You
Um,
give you a hug too.
oh, thank you. I know I'm like, there's too many new versions. I don't know how to do all the cool, cool versions of hearts. I don't know. So anyway, long story short, that book goes over the 7 most common tax strategies that we use. We call them the low-hanging fruit. It goes over the pitfalls. It goes over the steps, this kind of thing. Now, please, 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 if you're out there listening, get the book, please. But please don't try to do it on your own, okay? I give you as much detail as I can, but please have a strategist look over it. If you need help, have your CPA look over it, ask questions. I'm not a big fan of people taking advice from a YouTube video or a TikTok or a podcast, right? So make sure you're getting qualified help when you try to implement some of these things. But yeah, these are some of the main basic strategies that we use to get our average client average tax rate down to 6.92%. So I love it. It has definitely become the passion now, and astrophysics is now the hobby. So
That's awesome. I love that story. So since we're talking about the tax savings for the real estate investors today, so let's start with depreciation, because we know that in the multifamily syndications, depreciation is just like one of the key things, bonus depreciation, you get a lot of tax credits or say losses in the year one as you go in. So if you can talk about that, how to utilize those to reduce your tax liability.
absolutely. So again, you definitely have to make sure that are you the real estate professional? Are you the active or are you the passive? Okay, because this will impact the different levels differently. But let's stick with our real estate professional from this end. Cost segregation, cost seg plus a real estate professional plus somebody else who's making a ton of money. This combination is it is the golden child of the entire tax code. Okay. So let's say you've got one spouse making $300,000 a year on a W-2 and the other spouse as the real estate professional. Cost segregation allows any piece of real estate to be broken down into its components. So if we were to look around the room, so I'll pick on your room, right? We've got a plant and a table and artwork, but there's also a wall, there's wiring, there's lights overhead, there's a desk, there's probably flooring, carpet. I'm pretty sure you're not sitting on hard concrete, right? There's something in the room. When
Right.
you look at a building from cost segregation purposes, you are pulling apart all of the components of the building to speed up the depreciation. So
Mhm.
instead of, for example, an office building at 39 years depreciation, you're actually taking that depreciation over 3 years, 5 years, 7 years, 10 years, 15 years. And so often what will happen is if you've got, for example, $1 million purchase price, you're looking at a 30 or 40% write-off in the first year. So 300,000 or 400,000 in the first year. Now, you can also do this on residential properties, and often residential properties will actually turn out better than commercial properties, because generally a commercial property is much more, I call them featureless, right? It's white walls and white doors and some windows. When you look at a residential property, you're looking at marble countertops, you're looking at water faucets and lighting features, right? It's much more detailed. And so generally those people that are using, for example, short-term rentals with Airbnb providing that extra level of service, you
Mhm.
don't have to be a real estate professional. If you're giving that extra level of service, you can take cost segregation without being a real estate professional and still get the same benefits. So cost seg is amazing from the standpoint of getting big write-offs in the first year, first 1 to 3 years generally.
That's true. And this losses trickles down to the investors too in a syndication.
Absolutely. Well, yeah. So if you've got income coming in from the syndication in general, right, and you've got a K1 that's coming through, those depreciative losses will offset any kind of income coming through. Now, I always have to put a big caveat here, right, because it depends on how your CPA files your tax return. Okay, so please work with your CPA, make sure they understand that you are in a syndication and that you are expecting cost segregation to come through. We have also seen issues if people are in too many syndications, where the syndications are using what's called Section 179 to write off depreciation. There
Uh-huh.
are maximum limits that you're allowed to take. Okay, so this is one thing I always like to mention specifically for my real estate folks. If you go to your CPA, if you consider yourself to be a real estate investor in any way, passive, active, it doesn't matter. If you are a real estate investor, if you go to your CPA who's filing the tax return and you ask them what is cost segregation, and they give you that blank, like I don't know, I got to look that up. You need to leave. You need to find a CPA that specializes in real estate. It is a very specific section of the code, and if your CPA doesn't know how to properly handle it, you could be leaving money on the table. So.
Share with us one thing that they can miss out on, you know.
Yeah, one of the things that always comes immediately to mind, because we see this problem over and over and over again. If you, let's say you own a business, okay, and you buy a building that your business is going to be in, so you're buying the commercial real estate and you've got your business in there. If the CPA does not make, there's a one checkbox. If they don't make the aggregation election, you will
Mhm.
never be able to fix it. You cannot amend to fix it, okay? And you've missed out on the ability to take cost segregation against your business's regular income
Mhm.
for one checkbox. So it can actually cost you hundreds of thousands of dollars if it is
Yeah.
not properly filed. So
Mhm.
it's, if you're in real estate, and cost seg is like, it's the baby basic low hanging fruit, right? If your real estate CPA doesn't know what cost seg is, you need to run, not
That's
walk, run.
That's
So
right. That's a good
run.
one. And the other thing I was saying is that the cost segregation on the bonus depreciation is trickles down to the passive investors too in a syndication. And they can use those against their capital gain, even though they're not 100% able to use it against their ordinary income. But I thought there was some clause too, right? Up to 100,000 or 120,000, if you're making, you should be able to use some portion of that losses
Typically,
against.
that's the active level that's kind of in the middle. And so, yeah, you've got passive where you're doing nothing. You've got real estate professional where you're doing everything, right? Active, if your income typically less than about 150,000, there's a phase out between 100 and 150,000 that you might be able to take up of 25,000 against other income. So that's again, now my throat's going. Between the two
I
of us,
know.
our throats are just going today. We're too passionate about real estate taxes. Yeah, so that again is just your CPA needs to know what you're doing, how you're doing it, what kind of activities and time are you spending on your syndication. So if for many people in syndications are a way to invest money and it's passive. So you've got to be able to meet the active qualifications, right? And so maybe you have one property and a syndication, and it helps you meet the active qualifications. So you've really got to be looking at which level you're at to determine what kind of tax write-offs you can get. So
Great. So I get a lot of time this question too. So what are the tax benefits of structuring investments through LLCs? Because a lot of people, they come to me, they say, oh, I wanted to set up an LLC or I wanted to set up a trust, and I wanted to filter all the money through that. So I wanted to understand from you, is that like something viable option for people, or is it a right decision for them to set up an LLC? Because if you look at it, it's like a little bit overhead expense, but at the same time, it's like a little bit, hassle to manage too, LLC, if you're not into
yep.
it.
Yeah. We and I hope you're okay with me with this phrasing. It's a little tiny bit of adult phrasing. We call it the PITA fee, pain in the ass fee. Okay. Um Everything in the tax code, if it gives you a good, it also gives you a bad. Okay, everything always balances, always. Doesn't matter what it is, it will always balance. So yes, having legal entities can give you better legal protection. It can help you with insurance issues. It can help you with equity stripping. It can help you manage your taxes from that standpoint, because you can create a master entity where everything flows to the master and gets netted before it hits you. Okay. You can set up irrevocable trusts and you don't pay tax, the trust pays tax. So there's a million ways to use entity structuring to your benefits. But if you have entities, you have bookkeeping, you have tax returns, you have separate insurance costs, right? Now you have separate insurance properties. You might have separate bank accounts. Could you imagine 20 properties with 20 bank accounts? I mean, so
Mhm.
how you structure it is always kind of a balancing act. And the one thing that absolutely always catches my attention, sometimes we will see people come home from, I'm going to call them real estate seminars, right? And the guy at the seminar said that every single person in the room needs this kind of master and this kind of master and 15 LLCs. And then they spend 20, 30, $40,000 setting up this structure and they don't know how to use it, or they use it wrong and it hurts them rather than helps them. So when we look at entity strategy, we always want to start from the standpoint of where are you today and where do you think you're going to be in the next 3 years, 10 years, 30 years. Okay. Because of course, we want to plan for where you think you're going to be, but I also don't want to set up 35 entities if at the moment you have one rental. It's too much. It's going above beyond. So we want to know where we're aiming for so that we have a pattern, but maybe we only set up the master in one subsidiary entity before we set up all 35, right? I'd rather you save your money instead of paying the attorneys, buy another property and let's set up 2 LLCs, right? Like, so I tend to come at it from a more practical standpoint. What do we have now and where are we going to get to in the near future as to what do we think we need?
So this is more like on the active side. And then my question was more towards for the passive investors, because sometimes passive investors, they come to you because they have heard somewhere, or they attended a seminar, like you said, or a conference, or somewhere they heard that, oh, having a LLC, is going to protect them more. They're going to save more in taxes if they have a LLC. So what is your thought process? Because I don't think, because the thing is, if you're formed as a disregarded entity, still you're gonna be paying taxes to, it's gonna be billed to your social security number. We're gonna be using that, right?
100%.
Not necessarily your LLC until unless it's a S corp or C corp. Let's talk about that too a little bit. But first, I would like to hear your viewpoint regarding for the passive investors. When is the right time for them to form a LLC, or
Yeah.
is it altogether a good idea or no?
So, and this is, so I always have to put out a caveat right off the bat. I am a tax goddess. I am not a legal goddess. I'm not an insurance goddess. Okay. I'm not a financial planning goddess. I am a tax goddess. Okay.
Right.
For tax purposes, having an LLC, not having an LLC makes zero difference.
Mhm.
None. Okay. But you might be doing estate planning. You might have 4 kids and you want to set up a family limited partnership. Estate planning is tax planning just when you die, right? So again, for a lot of people, I think one of the most dangerous things that you can do as an individual is say, I heard that this worked for somebody else.
Yeah.
Okay.
Mhm.
Because tax strategy, tax consulting, anything to do with taxes is you. Are you married? Are you single?
Mhm.
Do you have
Mhm.
kids or not? Do you have dogs? Are
Mhm.
you in real estate? Do you have an operating business? Do you want to move out of the country? Do you want to live in Puerto Rico? Like, there are a million questions that a good tax strategist needs to ask you to understand who you are and what you want to be able to properly create a plan. Because if you're just doing what your next door neighbor is doing, you don't have the same facts and circumstances, even if you think you do. And this always catches my attention here. We had a
Mhm.
case once,
Mhm.
neighbors, literal neighbors, husband and wife, both of them had 2 kids, both of
Mhm.
them had a dog, both
Mhm.
dogs were golden retrievers. I mean, it looked from the outside, they looked identical. Both had a business making about the same amount of money. Okay. One of the neighbors got a tax plan. They decided that they were going to copy the tax plan and they were going to do, because they thought they were identical, do exactly the same thing. Okay. Things that they didn't realize weren't identical. The other family had an aging parent. Okay. Aging parent had a net worth of a little over 25 million. They never
Whoa.
included any of that in the tax plan. That one fact, aging parent, 25 million estate, changed the entire tax plan, actually cost them money because they tried to do a copy and went, no offense to anybody, but they went the cheap route. The cheap route. Oh, this is
That's
going
true.
to work for me. I'm just going to make a copy. Don't do that. You will bite yourself every time. Make sure you're getting the proper advice for the professional you need for whatever it is. So, yeah, sorry for the soapbox, but I've seen it happen too many times. So, yeah.
Yeah, I agree on that 100% because people try to save money here, there, little bit crumbs here, there, but they do not realize the long-term losses, in the long term, how much they can lose or how much they can make,
Yes,
by
100%.
reinvesting, by using all these strategies that they can get much faster ahead of the game, and that's what people don't realize because it's not worth it. Just, sometimes people say that, "Oh, I'm paying only $1,000 to my CPA. I don't think I'm going to pay $5,000. But the thing is, there has to be some difference
Yep.
between that kind of cost, and
So,
whatever is the value you're gonna get is not gonna be the same, and it's gonna put you way ahead in the game. So since we talk about the little bit about the cost segregation earlier or the bonus depreciation,
yeah,
I would like to also ask you a question about the 1031 exchange.
sure.
Because how can real estate investor leverage 1031 exchange to defer capital gain taxes
Yeah,
when selling a property? Because they have like 45 days for the exchange, right?
yeah,
And let's talk about both ways, active and passive investors as well.
sure.
Because passive investors too, they should be able to reinvest in a syndication project, right? They can go into a tick structure and if there's a possibility.
Yeah. So let's talk about and let me back up because again, this all depends on your situation. Okay.
Exactly.
There are
Mhm.
multiple different strategies that you can use to get out of tax on a sale. Okay.
Mhm.
Now, some of them are get out of the tax completely. Never
Mhm.
pay it, never ever, zero. Okay. Some of them are kicking the can down the road, like
Mhm.
1031. Okay. So sure, yeah, I'm going to get out of the tax now, but I
Mhm.
have to go back into real estate. So real estate to real estate, I got to be in real estate. Okay.
Mhm.
What if I don't want to be in real estate? What if
Mhm.
I'm older and I no longer want to manage properties and I
Mhm.
want to go from real estate into a syndication? Or I
Mhm.
want to go from real estate into stocks and bonds, right? Just interest, right? US treasuries. I just want to live on the interest. Um, there 1031 is the most common of all the strategies, but it just doesn't fit in every situation. What if you can't find a replacement property in 45 days?
Mhm.
This is one of the biggest things we're hearing is like, I've looked and looked and I wanted to do a 1031, but I physically cannot find a property that's a good deal anymore, right? I don't want any of those properties.
Mhm.
So 1031 certainly exists. Okay. 1031 is real estate to real estate, period. Real estate to real estate. You have 721, which is real estate into typically some sort of partnership. So that would be your syndications, right? So I am active or real estate professional now. I don't want to do that anymore. I want to sit back. I'm older. I'm retiring. I want to be passive. So you can do that. You can use 721, which is another code section, and go to the more passive side. Now, there are other strategies, the installment sales trust, okay, where I don't want to do real estate again. I'm done with getting the 2 a.m. telephone calls for toilets. I don't want it anymore. I want to buy a Subway, right? A franchise. I want to buy artwork or gold. I want to invest in, I don't know, Puerto Rico, something, I don't know, whatever, right? Like whatever it is you want to invest in. The installment sale trust is a great option for that. Okay. There are some people that want to get out, but they want to give a bunch to charity. Okay. There are charitable, I always call it the CXXT types of trusts. Okay. There's CLATs, FLUTs, CRATs, CRUTs, CRTs. There's a million different if you're interested in charity. Okay. So you can get out, defer a bunch of tax, and get out of it from that standpoint. You can use LLCs with charitable intent to get out of the tax on a big sale. So it's very difficult to know, well, which of these should I use, right? Because again, it's so dependent on what you're trying to do, right?
Exactly.
So 1031s are great. Real estate to real estate. 721 is the next most common thing we see. Real estate to syndication, real estate to some sort of partnership interest in real estate, REITs, those kinds of things. And then the third most popular, I would say, is probably the installment trust, because people are just, I'm done with, I've made all my money, peak of the market, I'm happy, I'm selling out, but I don't want to buy back into real estate. I want to go into something else, stocks, whatever. So
other option could be the DSTs too, right? A lot of people, they do that
yeah,
as
the
well.
installment trust and the DSTs. So it depends on if you're talking, so there's two different versions of the DSTs. There's Delaware Statutory Trust and there's Deferred Sales Trust. The Deferred Sales Trust, it has effectively changed its name. It's Installment Sales Trust. So those two are now the same thing. So yeah.
Okay, so what is this? What is the implication with 721? So is it,
It's identical to a 1031 from that standpoint.
but do you go in a tick structure when you're in a 721, or you just kind of deploying into syndication as a limited partner?
It would normally be going to a limited partnership. Yeah. So it could be syndication. It could be any kind of real estate partnership is the technical definition. So
And do you have to put all the money, whatever you got from the sale, everything has to go into syndication, or
it
can you take
works
something off?
just like a 1031. So
Exactly,
yeah,
100%. So no
same thing.
taxes, no penalties, nothing. So you're
Nope.
doing a 721 structure. So every time, whenever that sale happens, you reinvest into the next property. Or can
Correct.
you just kind of exit, at the sale, and then you can reinvest and kind of in a
Well, whatever.
diversified portfolio,
Yeah, and so let me back up. With a 1031, with a 721, just so we're saying the same thing. Let's
right?
say my total sale is $1 million. Okay. And so either I'm going to 1031 into $1 million worth of property, and if that's 10 $100,000 down payments or whatever, right? Whatever the deal is, okay. Or I'm doing $1 million into a 721. If I decide that instead of putting the full $1 million into whatever the other thing is, I want to only put in 800,000, I want to go remodel my kitchen for 200,000, I will pay tax on anything I don't put in.
Putting,
So
okay.
yeah, from that standpoint, it's identical to a 1031 or a 721. So
No, but how about at the exit? Let's say I put it in a syndication for 5 years. 5 years down the road, let's say my $1 million, I got 2x multiple, maybe I have $2 million now. So do I have to find another property to do 2
unless you
million?
want to pay tax on it.
So
Yeah,
it's just like you use I like the term that you use, kicking the can. So basically, you're deferring the tax as far as you can.
correct.
Well, that's all the good information. I really enjoy that. Awesome.
Yeah.
So I know we are out of time and I have a lot more questions. I'm going to have you back and then we can talk more about, how to, create the best possible strategies for ourselves, to save money, whether you're passive or active. But at this time, I'm going to ask you if you can share one golden nugget with my audience.
Sure. Golden nugget, specifically in tax for real estate?
Whatever you like. Yeah, tax will be really good. Everybody's looking for advice in taxes.
Oh, well, okay, let me put it this way, because the golden nugget that's coming to mind right now is, listen, the instant you hear that there are such people as tax strategists, so if this is your first podcast ever where you've heard about, tax strategy people, the sooner the better. Okay, I'll give you a perfect example. There was just a tribal credit that opened up, and it is only valid from today until October 21st. So 6 days, okay? And I don't know when this podcast is coming out, but if you are not connected with a tax strategy when that golden opportunity, when that golden nugget comes up, you won't know about it until it's too late. So find a strategist, find somebody you like working with, get on their roster, and that's how you save money. So
Great. Thanks for that advice. And then this brings us to our vibe rapid fire round. I'm going to ask you 5 questions. You're going to answer it in 1 word or 1 sentence only. Are
okay,
you ready?
ready.
All right. So first question is, what is one of the most important things that you've learned in your life, and how did your life change after learning it?
And it's only 1 word. I can only give you a 1 word answer.
1 sentence.
Oh, I was gonna say, like, oh my goodness. Do or do not. There is no try by Master Yoda. You either do it or you don't, and that's the answer.
That's true. But the thing is, if you do it or don't do it, what is the difference? You
Oh, it's
know,
whatever
some
difference you
people,
want in your life. Yeah, 100%.
exactly,
Yeah.
exactly. That's what I need to say. That's good. Share one good book other than your own book.
4 Hour Work Week, Tim Ferriss, my favorite.
That's a good one. Yes. In 1 word, what does life mean to you?
Fun.
Oh, I like that. That's a really good answer. Yes. You gotta have fun in your life. What is your biggest passion?
Uh, my brain is instantly going to my dogs, my fuzzy dogs. I've got
All
5 of
right.
them. They're great.
Wow, you're dog mama, huh? That's nice.
Yes.
That's nice. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
Always keep your ears open for new opportunities.
I like that. Just being aware, right? Live in the awareness all the time.
100%.
And you'll be connected to the universe,
Yes.
getting all these opportunities. Awesome. So tell me, how can people reach out to you?
We're super easy to find. So taxgoddess.com, and you can find me, my team, and work with us. We would love that. So
Awesome. Thanks for coming to my show, Shauna. I really enjoyed talking to you. I will definitely love to have you back because I need to pick your brain more. There's a lot more.
I would love to be here. This was way too much fun. Thank you so much.
Thank you.